if anyone is okay holding it, then just hold it and let it ride. I mean, that's probably a good play, and a wise play, because it's good to own real estate. But if you need your capital, or you're not more, an investor, then getting out now is probably better than waiting 5 years.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny, and I'm joined today by Tim Gordon. Tim is a San Diego-based real estate investor. He owns rentals, flips homes, and wholesales real estate. He created one of the first iBuying websites in 2014, and since then has done over $65 million in deals. Tim, welcome to the show.
Thanks for having me on.
Absolutely. Excited to have you. Before we get into the fun stuff here, we were kind of chatting offline, obviously. A lot's changed and feels like it's changing hourly. Kind of take us back, though. What were you doing before, and what kind of caught your eye and led you to real estate?
Okay, so I've been involved in real estate investing for just about a decade now, and I was in outside sales prior to that. And so this was 2010, 2011, when I was sort of witnessing what other people were doing in the real estate. The market was very different. And sorry, busy road. I just started learning about the opportunities here in Southern California. So I slowly ventured into, I first of all bought a fourplex with a FHA 203K loan, which is sort of the often talked about, rarely used loan for first-time home buyers, where you can get the financing to include the construction of the property. And after that, I just really enjoyed what I was doing with real estate. So I started with direct mail marketing, and then worked my way into utilizing internet marketing back in 2014. And that's what I've been doing ever since. And I'm very much more of a lifestyle investor. So I've built a little portfolio and do my deals, and then spend the rest of my time traveling and enjoying experiences that I want to do while I'm young enough to enjoy them.
That's awesome. I love that so much. And that's why I love real estate, because there are so many different facets of it, right? So many different ways you can be successful, and success looks different to other people, right? For you, like you said, you're more lifestyle. Some people want to go be billionaires, and you can do all of that in real estate. That's what's so amazing about it. So as a lifestyle investor, obviously, you're pretty much, sounds like you can probably work anywhere with a Wi-Fi connection for the most part. Kind of explain the internet marketing side of this, and how you leverage that to really be successful.
Sure. Yeah, it was a lot of fun, actually. I was, in some ways, I wished I'd built it bigger, but in other ways, I look back at the last time I've spent, and all my proudest moments are from just enjoying life. And so for me, internet marketing was a way of keeping my costs down and my overhead low. So if there were periods of time where I wanted to go travel, I was able to do that, and it wasn't really going to have much of an effect on the business. And I started out with direct mail marketing, and it was effective, especially around 2013, 14. Started to become less effective around 2015. But there was a lot of stress involved with just keeping that machine running and the costs involved. And my predictions were basically, people are going to use the internet more. It's going to become more of a resource for people looking to sell their homes. So why not be one of the first people out there who has an established website? And the first person who sold me a house was in 2015, and it was the son of a homeowner. And he was, in his mid-20s and trying to figure out how to help his parents sell their house, and they located me. And that was sort of the indicator to me that, okay, more tech-savvy people, and the trend will keep shifting this way. And as you can tell from other companies now that have, the space has really blown up. That was a pretty good prediction. And it's a little bit tougher now to rank, and a little bit more competitive market, but I still exist in that space and still do deals consistently from that marketing channel.
That's awesome. And so explain what is it the website is like. You're basically offering cash, or how do you kind of get that drive traffic?
Yeah, I mean, the goal is basically you've got two ways you can do this. So you're either going to pay Google to show up at the top and not do any work on the website. You're just going to pay to get placed there, and that's going to be your pay per click. And that will deliver a different type of seller, and it is effective, but you're going to have similar costs to doing direct mail marketing. So in this market, I wouldn't be shocked to spend $3,000 to $5,000 a month pursuing that. The other option is to show up organically. So you're going to build out the website and have it to be a very healthy and strong content-based website. That the aim is basically if homeowners sitting in your target market and they hop on Google and they type in different search terms that you've researched that are popular, like maybe sell my house for cash or get a cash offer for my house. The goal is to rank as high as possible so that you're the person that they go to have that conversation with. And once that lead's in your hands, then it's pretty much the same as any sort of other approach. But it's basically getting your website to show up as high as possible in your target market for those search terms. And if you're good at it, it's a pretty cost-effective way of sourcing deals. And the personalities of the sellers who take this approach really aligned with my personality and how I like to do business. So that match made me just a more enjoyable process for doing work. It's typically, for me, it was often owner-occupied sellers, which I think most people in the residential space will agree are going to be easier sellers than, say, a landlord who has a tenant in place, because now you've got three parties involved versus two, and one of those parties isn't necessarily going to want to leave. So that sort of paints a picture of the approach to sort of sourcing residential real estate from the internet.
Interesting. And you're obviously in a tenant-friendly state as well, so that presents its own challenges in that avenue as well. So do you only invest, is all of this only happening in California?
No, I've tested it out in a few other states with mixed results, and my motivation is primarily California. So I've tested some things out just in the spirit of marketing, sort of a lot of testing and a lot of trying ideas, seeing what works and being okay with those that don't. And so I've done this in Michigan, North Carolina, and I think I've closed a couple deals in some like Oklahoma or something. Those were really random. But that's the other weird part about using the internet for this stuff, is that most other types of marketing for real estate, you're going to be pulling a list for the types of properties that meet your criteria, and can't do that with the internet. So it's more like casting a big net and then just seeing what comes in, and then figuring out which ones, what of those leads can be monetized or make good investment plays.
Interesting. And what are you seeing now as we're kind of heading, I mean, subjectively, I think we're in a recession, right? I think a lot of people would agree there. To the degree of it, probably subjective, but are you seeing any changes? Are more people reaching out? Are you getting more leads, any, or less, perhaps, anything like that?
Great questions. We're noticing a huge spike in homes that are listed with real estate agents. Huge. It went from being maybe like 1 out of 10 leads to being like 6 out of 10 leads, where it's a person's house is listed for sale. It's not selling. They're starting to freak out, and they don't have the same understanding of how this business works. So they just see some person offering to pay cash for their home, and they figure, all right, well, I have a $900,000 house. If you'll pay $870, let's go. And clearly, it doesn't quite work like that, because there's not really an investment play on numbers like that for most single-family homes. So huge spike in listed homes, which can't really do a lot with those leads because they're already listed with an agent. And so all we can really do is advise them to lower the price, make improvements to their house, those types of things. I would say we've seen a decrease in lead flow, I guess a decrease in leads that we can utilize. So on an upswing market, we could buy houses, even light fixers, and make them work because the market was sort of appreciating up, very competitive, for buyers. And so we would often tie up a house, either wholesale it or tie up a house, do light work, list it and sell it. In a declining market, that has completely shifted. And so in regards to buyers of our wholesale deals, there's very few right now. And if it's and the margins they want are fairly great. And if it's a high value house, say over $1 million, it's unlikely they even want to touch it from the buying side. So we've seen sort of a decrease in deals that we can do much with across the board. And it's gone back to probably a more normal market, which would be, say, 2015 to 2019, where it's got to be like a mid to heavy fixer, and it's got to be at a pretty substantial discount. Otherwise, I'm not going to buy it, and somebody else isn't going to buy it. So it's definitely shifted here, and it shifted pretty early. We were feeling that by about May, June, and there were still people who would buy the deals, but I witnessed it from other companies who were offloading their portfolios. People were still buying deals, but they're now stuck with those deals 3 months later, 4 months later, where they underwrote it based on a market that doesn't exist anymore. So the market has definitely cooled down considerably here.
Fascinating. Yeah. And that makes perfect sense, right? I think a lot with obviously interest rates going up, a lot of sellers waiting, right? If they don't have to sell, obviously you're running into people who have to sell and were not prepared for their house to sit on the home for 1, 2, even 3 months.
Yeah, definitely.
And you're definitely still, and this is happening in the commercial space as well, seller sentiment has not come back down to earth, in the sense that sellers still don't want to accept the fact that their house or their asset, whatever it is worth less now. And that's just the market we're in.
Absolutely. And it's starting to shift. I think a few months ago, it almost felt like it wasn't even worth speaking to someone. It was just such a huge disconnect and a gap between the sort of information, and especially in residential real estate, because you've got sort of the sale of a property, and best case in a very fast situation, we're talking 90 days until that thing is listed, sold, and there's new data to show how it's doing. And then as in a declining market, it's probably going to take 5 to 6 months for that data to be present, and then for the news to report on it. And so starting to see that shift now, but there's definitely a gap. And then for me, we've noticed the only people who are selling now are I call them the gotta sells. So that would be relocating. They need to take their equity to their new location to buy the next property, or there's been a death, and perhaps the family needs to settle the estate, split the funds up. Those are practically the only two situations where I'm seeing where someone is willing to sell their house right now. The rest are either going to wait it out as of right now, or sit in denial. But we're having conversations now with folks who are basically just saying, look, like the picture doesn't look like it's going to be any better a year from now. So I would really make a move either now or be happy waiting 5 years plus. And then that's their call to choose.
Interesting. Yeah, it makes perfect sense, right? You see a lot of listings, motivated seller, right? Which is realtor talk for desperation. They need to get out.
Yeah.
That doesn't surprise me. But on the other side, right, I think interest rates at 7%. So it's like this sort of, you're seeing an ebb and flow in the game now, where prices were so high, right, that sellers are still struggling to accept that they've come down. But how much have they come down? Because on the other side is a high interest rate, so it's like, is there really a discount for a buyer right now? Do you really want to be a buyer?
Yeah, it's the only time it works so far is the gotta sells, because everybody else just isn't there. And even then it sort of is slowly eroding down to that value. So it's I'm just trying to think for some profiles. It's all relocating, death. That's it. And the other folks are just sitting at a higher price, and they're not willing to come down. And so it's slowly chipping away, ever so slowly. But we've got some other elements that are interesting here in California, where, one, we have high interest rates, and two, property taxes don't reassess like they do in other states. So say you buy $1 million house, your property taxes plus or minus are going to be just over 1% of that property. And they're not going to reassess in the future at great amounts. So the number will go up, but it only goes up 1% each year. So for example, like I live in $1 million house, but I bought it for $300,000 10 years ago. My property tax bill is around just under $4,000 a year. the same, neighbor across the street buys the same type of house for $1 million a year, their property taxes start at $10,000 a year. So it's going to start freezing people into their real estate because you have a low interest rate and you have low property taxes. So I'm paying, $2,000 a month to live in a house that my neighbor is probably paying $7,000 or $8,000 a month to live in. So there's no chance, barring, some catastrophic event or life event, there's no way I'm selling my house. And so we're seeing the market just getting frozen, where sellers have to stay put, and buyers who don't own homes yet are kind of stuck out of it. Which fortunately I don't have a solution to that, but I really empathize with them, because it's a completely different world that we both live in, even though our homes are on the same street.
That's fascinating. Very, very interesting. And so what do you foresee? You mentioned that, you're telling people, if you need to sell, or you got to sell now, or you're going to have to wait 5 years. It sounds like you think this is going to be a long, drawn out recession or downturn, whatever you want to call it.
Yeah, I mean, I'm probably someone, I would classify myself as a more conservative investor. I'm not going to say perma bear, but the information in front of me doesn't really look that great. We go into a recession or any of that stuff, fine. Like that stuff happens. I'm not like doom and gloom, but I can't imagine interest rates going back into the 2 range ever. 3 range, probably not. 4 range, maybe. And so I just don't think that the conditions that we had are going to come back in the same way. And so a more normal and healthy market probably does exist with interest rates at 4, 5, 6%. But I don't see that happening in the near future. So I think for me, I'm just saying, I guess it is tough, right? Because if it's at 7 now, where do we see it going? I'm not sure, but I personally think, yeah, we're going to see values correct maybe 10% a year until it's in line with where these interest rates are. So yeah, to me, I think folks have probably missed the boat to get top dollar, and if they just have to make that choice now of what suits their life. Can you sit on a property for a few years and write it out, figure out if it works? Or if you can't, then I would just say rip the Band-Aid off and get it done, and go take your equity and go live your life instead of having to sit in lurch. I saw that a lot with homeowners around 2012, 2013, when I was really getting into marketing for real estate, where we would encounter these either accidental landlords or folks who sort of gotten tied up into the hype of the last, bull run, and they'd wanted out of the house since 2006, 2007, but weren't able to. And finally, by about 2012, 2013, values had sort of came back to be about even with where they needed to be to like sell, get their money back. They were no longer looking to profit. They were just, let me break even, let me get my capital back. And that took 5 years of them being landlords. And so I kind of see that same thing likely occurring again. And so if anyone is okay holding it, then just hold it and let it ride. That's probably a good play and a wise play, because it's good to own real estate. But if you need your capital, or you're not more, an investor, then getting out now is probably better than waiting 5 years.
Yeah, absolutely. I couldn't agree more, just because, and listen, you're not going to get the top dollar, but you're not, in a lot of markets, you're not taking a, 30% haircut, right?
No, it's not that bad. Just for an example, I flipped a house earlier this year, and so this is to kind of paint a picture for Southern California. It was a 3-bed, 2-bath, 1,200 square foot. My purchase price was 500, and my exit value was 700. And that's like a nice healthy flip, like a double. Yeah, that's like a double.
What do you typically got to put into something like that to?
I think that was about. You're going to probably spend about 80 to 90,000.
Okay.
That used to be about a 60 to 70K flip, but now I'd say 80 to 90.
Yeah.
And so I underwrote that at a 700 exit. It ended up selling for 760, which was sort of peak frothiness of the market in February, March. And I couldn't believe it, but I also knew that wasn't going to last. So that deal sold. I've been following a property that I would say is pretty similar condition, and it's been on the market and fallen out of escrow a few times, and it's now at 685. And so it was 750, 720, 685. So now we have a property that was pretty similar to mine. It's now below my underwriting value before the spring got kind of frothy, I guess is the word I'd use for it. So we're getting below that now. I would probably guess we're at a 10% down from the current market peaks to maybe 20 if it's a very odd or weird property. And the information I'm looking at is just saying sort of just a slow decline as prices are sticky, sellers are kind of stuck on those numbers, but as the gotta sell, and as more cautious buyers buy, it's going to sort of slowly bring those comps down. No one I talk to sees any sort of massive drop because we're not going to have any flood of foreclosures or anything that then creates all of these sales comps for appraisers that they have to use. That's just not going to exist. We're just going to see lower sales volume, and we'll probably just inching our way down to a more normal and hopefully healthy market.
Yeah, absolutely. And it's the exact same thing in the commercial space as well, very slow. And that's how I kind of see this, right? The next 12 to 18 months going to kind of be a slow bleed. Obviously, the Fed has made it, very apparent that they're trying to trigger recession, because things need to slow down, right? You've got debt issues all over the place, especially in the corporate sector. You've got asset prices through the roof. You've got rents through the roof. All of that stuff needs to cool down, on top of obviously, overprinting of money and blah, blah, blah. I mean, we could do a whole podcast just on that stuff.
Yeah.
But the Fed has made it clear that there's going to be 2 more rate hikes just this year, right? So one next month and then one December as well. So very clearly trying to really just hit that stop button and slow things down. I'm of the idea that we could start seeing them ease up at the end of next year, maybe beginning of 24, in terms of maybe not necessarily raising and even potentially bringing it down a little bit. But, that's pure speculation. I'm not an economist.
Yeah. So. Yeah. And they might. And I think, it's just fun to talk about. And we're all speculating.
Absolutely.
None of us are experts, but things were just very odd. I remember just saying to my wife after a few deals, the money we made on them, like, I'm not a genius. I'm not some financial whiz. Like I can't be sitting here just thinking I'm, the smartest real estate investor, and this is why these things are occurring. It's more about just sort of a good fortunate positioning and timing, and playing a hand well, while it's suitable to play it that way. But the cards have now changed, and these cards will be changing. And I think that smart investors are making those adjustments, and we're going to be underwriting things differently, which we already see, and then we'll be more cautious. And I don't know the commercial space as well. I love multi-unit, usually like smaller multi-unit, but there were deals that we were buying and other investors were buying that really in a more normal market were better suited to a homeowner. And it would have been the homeowner who was like, oh, it's a good house, good bones, just a little dirty or outdated, but there's nothing that would stop you or I from like cleaning it and living in it without feeling grossed out. And those are the types of properties that homeowners should be buying. And then the properties that investors should be buying are the ones that, need more significant repairs or have some type of an issue that we're willing to solve to then create value. And for a certain period of time with that run up, that wasn't even necessary. We could just grab a house and offer cash, and that would be a great incentive to a homeowner, and they were getting a lot of equity because the market was running up, so they didn't really care. They were hitting their number, and it was removing properties for homeowners that they should have been able to buy, and then we'd fix them, mark them up 10, 20% or whatever it was, and sort of forcing them to buy those freshly renovated homes. And that's not really a market that I consider very healthy or effective. So I'd be quite happy if rates, adjust down a little bit in the spring, and hopefully we see a world of maybe 5% rates, and then things start moving again. But we're a little bit more cautious, and there's going to be more spread, and it's going to remove some investors from the market, as it already has, because they can't do it anymore, or they've lost out on deals, and they don't want to get back in because they've gotten burnt.
Yeah, absolutely. It sounds pretty similar to the commercial space as well, where you had a lot of investors who, you know, knew what they were doing, but really got, I don't want to say lucky, but much like you, right? Where, you underwrote at 700, would have been very satisfied with 700, got 760, right? No, it doesn't matter how genius you are, intelligent you are, how great of an investor you are, you can't really predict that kind of thing, right? And like you said, you're conservative. So you had a lot of investors in the commercial space really just be sort of timing the market, everything really go in their favor, didn't really have to implement a business plan. Now you're seeing where a business plan is, you're buying an apartment complex, it's a business where you really have to implement a business plan, and they're struggling because they haven't really faced these struggles before because they just weren't there in the last 3-4 years when a lot of people started to get into the space.
Yeah, I aim to be doing larger multi-unit and explored this at depth over the last 2 years and missed out on multiple properties. And the numbers, my specialty is relationships with sellers and working with them and building that rapport and being the best option for them. But there was just no way to be the best option when I couldn't compete with the numbers, and I was underwriting more conservatively. I remember losing out on a 20 unit in Raleigh, North Carolina, and I think we were 20 to 30% off the highest price, and I everything we wrote out, I just couldn't see how it worked, and I think it was just so much capital that just needed to be put somewhere. People were so comfortable putting money out, and I imagine you might be experiencing this now. It's a completely different world right now. Instead of buying at 700 and being surprised at it going 760, someone might be, or sorry, exit value at 7 and it's surprising them at 760. They could be penciling in a 10 or 20% decline to be safe. I can't imagine anyone buying a deal right now and not putting a good amount of time into just considering, okay, well, what's a worst case scenario? Where could this go? And are we ready for that? And are we stress testing our business to make sure we can do that? And now we have to go back to being investors and not speculators, which is actually kind of nice, but it's a bit of a shock to the system for all of us.
Yeah, wow, that was very well put. Yeah, absolutely. You actually have to try now, right? Underwriting a lot of deals, a lot of stuff not penciling, like you said. And, it's real work now. And as someone who, I primarily focus on raising capital, it's a lot of conversations with investors who are just sitting on the sideline, and that's okay. Right. In the end, you have to make the decision that's best for you. But, the only thing I say to those investors is, just be careful sitting too long, because then you get so comfortable on the sideline that it's hard to get back into the game. And
Yeah,
oh, by the way, your money is quite literally burning while you're sitting on the sideline. So you just have to find where that sort of happy medium is,
it is. Yeah, and I agree with you. That's one of my traits is I've actually been challenging myself to sort of invest in other people's stuff with some spare cash, and I've always found that very hard to do. And so I can definitely understand with what you're saying about sitting on the sidelines too long. And I think there's certain deals that are going to be pretty solid, through most, market ups and downs, and other ones that go from being a good in-out play to being practically toxic. And those are the ones we just have to avoid. And so, but it is fun. I mean, it's funny to think of the shifts, and there's going to be a lot of creativity and intelligence will be rewarded as this market shifts, whether that's, I've had a lot of thoughts about, perhaps less residential, but maybe like a commercial property owner who definitely seem to be more amenable to creative financing and things like that. Someone who might know they want out, they know they don't want to go through a whole new market cycle, but they're not going to get the number they wanted. Perhaps that person's going to be more open to holding a note or some type of creative financing at this point, because they're not going to be able to get out as quickly and easily. And I mean, this too, but I mean, that's usually better in most cases. They get a monthly payment, their money's just not sitting in the bank, all these reasons. And so I'm pretty excited about the prospects of that moving forward.
Yep.
And I want to learn more about that. I want to try to talk to more people about that. But that's one of I think the new opportunities that I see approaching with the market and its adjustments.
I love that you brought that up. I just had this conversation a couple of weeks ago on another episode where you're going to start seeing a lot more creative financing, because cost of capital is so much higher, right? So you can't just go out and raise the equity now, because investors are sitting on the sidelines, so it's harder to raise capital. You can't just go, get a hard money loan, because those are jacked through the roof right now. So you're seeing this sort of, like you said, you got to try now, right? Hey, are you open to some sort of seller financing, creative financing? How can we make this a win-win for everyone? And like you said, I love that so well. Now we have to be investors again. And it's going to be really fun, because it is going to knock out those who can't hang. And it's, in 5 years, those that are left standing are going to be the ones that were able to get creative and, problem solve, really.
Yeah. It's weird. I think I always feel like this young kid, and like I'm about to turn 40, and it's funny to think that this is my sort of, I got in at the ground floor, the last cycle. I mean, it crashed in '08, but not a whole lot happened between like '09, 10, 2010, 2011. I was learning a lot about it. I had some friends who were involved in it. And it was funny. I remember telling people I was getting into real estate investing, and they would just be like, are you insane? And I was saying this to my dad. I was like, I don't think the market's going to really be at its next stage until I tell people I'm in real estate. And they're like, oh man, sorry. And then I'll be like, okay, now I know we're back in it. This is where the opportunities are.
That's awesome. I love that. Well, Tim, this has been incredible. Love all your insight here. And it's nice to kind of get a feel, because I know a lot of investors, especially, like I said, I'm obviously more involved in the commercial space, but a lot of investors pay attention to what's happening on the residential side. And so it's really nice to kind of get that perspective and, understand what they're seeing and why they may be feeling a certain sentiment, because I'm obviously biased and think that we should just keep on plugging along. And you're obviously, kind of in that same boat as well. So we'll wind down here with the final 5. First question: best advice you've gotten from a mentor?
It's funny. This person I had a really bad sales manager, but he once told me this advice that I actually will give him credit for, which he said, sometimes you don't have to win to win, which I really liked, because it to me, it was saying like, check your ego. You don't need to like prove you're right to someone. If you're in some sort of like a dispute where personalities are kind of clashing, that like checking the ego, like letting go of things, and whatever your goal is probably bigger than this clash of personalities. And so letting go of those things and not letting things get personal will likely allow me to achieve my goal faster, versus sort of like getting into it. And as someone who is in the corporate world, I really enjoyed that advice, and it's helped me sort of let things go, be the bigger person, and just focus on the goal at hand.
I love that. That's funny. I also had a sales manager back when I was in tech sales that I did not get along with. However, the one thing he taught me was, and I'll give him credit for, and he admitted that, it wasn't an original idea, but to fail fast and fail forward, right? So basically just, speed wins, right? So with speed is going to come mistakes. Just keep moving forward. And, I'll never forget that. So shout out to Woody.
That's great advice.
What is it about your career that makes you feel like you're fulfilling your why?
For me, it's all about lifestyle. I really thought about my 30s. As I spent a lot of my 20s. I moved to California with nothing, and I start completely over, and it's really hard. And as I entered into my 30s, I decided that travel and experiences and living life before my body was too sore to do it, and before my tolerance for inconvenience wasn't that great. And so the business has allowed me to go. I mean, I've been so many places, and I've been on these really long. I mean, I've gone to India, I've gone to Africa, I've gone South America, like just all over the world. And I've also managed to spend a lot of time with my family, and we live all over the country and the world. So for me, the why has always just been the freedom to go do things and to go experience things. I placed a lot of value. Like I thought time in my 30s was worth multiple millions in my bank account. And I'm very close to 40 years old, and I look back at that and I feel pretty good about the decision. I've still done quite well in real estate investing, and could have always done better, but I can't get those years back, and I can't get those experiences back. And so for me, that was really, really important. And I understand that's not for everybody, but for me, that was the why. And looking back, I'm really happy I made that call.
That's awesome. I love that so much. That's incredible. Yeah, you really can't get that time and those experiences back. And I'm kind of in the same boat. And, certainly, you may, like you said, right, could have done better. There's some things I wish I could change, but ultimately the experiences I had are far, far more worth it.
Yeah.
Favorite non-real estate or investment related book?
There's a book. It is still personal development. I don't know if that's going to.
No, that counts. Yeah, definitely.
Okay, so it's a book called Conscious Living. Author's name is Gay Hendricks, and he's got a book called Conscious Living, a book called Conscious Loving. So living obviously is yourself, your life. Conscious loving would be in relation to relationships. And then he's got another one, which is sort of a spin-off called The Big Leap. And but it was a game changer for me. The book really helped me sort of adjust and evaluate my life. I wouldn't be happily married if it wasn't for this author's books. So I would highly recommend Conscious Living and anything by that author. The Big Leap one's really great too, because it talks about self-sabotage and a thing they call like upper limiting, where maybe you're trying to like break through to that next level, and maybe there's self-worth or like sabotage going on. And so I think for anybody in these types of spaces that we are, there are these barriers subconsciously that we break through to reach the next levels of success. And so that's honestly only about 10% of this book, but I think that for people listening to this show, that's sort of my my little like worm on the hook to kind of like pull you in and encourage you on that book.
That's awesome. I love it. I added that to the list. That's right up my alley. So I'm looking forward to that one. If you could have any superpower, what would it be?
Ooh, I don't know if I really would want one. I guess the ability to fly. If I think of pure happiness, the ability to fly would probably be the greatest.
Yeah, that's my answer too. You got it. That would be awesome. Cool. So you obviously don't typically work with other investors, but if someone want to get a hold of you, reach out to you, what would be the best way to do that?
My website, which is just gordonbuyshomes.com. You can always call me or email me, and I would definitely encourage folks, don't be shy to call. I even feel nervous about calling people who I think are on different levels than me, and 99 out of 100, they're really friendly and helpful. So always encourage that. You can also find me on Instagram. It's just Yo Soy Tim. And either of those ways, you're welcome to reach out. And I really like people and having conversations with people. So if anyone wants to have a conversation, please do.
Cool. We'll link the website in the show notes. Tim, this has been absolutely amazing. Thank you so much for your time.
Yeah, my pleasure.
Absolutely. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to KataniCapitalGroup.com to learn more.